In this week's market update, Tory conference kicks off in Birmingham, Tesco takes on the discounters, Tesla bounces back and Royal Mail in the red. It's a Tory conference this week and all eyes are on the events unfolding in Birmingham. The Conservative Party are hoping this year's conference won't be as dramatic as the last one, which will mostly be remembered for the Prime Minister fighting off a coughing fit during her keynote speech as the stage set started falling behind her. Chancellor Philip Hammond took to the stage yesterday, calling on the Conservative Party to regenerate capitalism, as he defended a system which he said had delivered 200 years of economic growth and lifted millions out of poverty. The Chancellor said his party should not try to match the illusory utopia being put forward by Labour and not try to outspend the opposition with short-term gimmicks. Unsurprisingly, with the weekend papers full of headlines around Boris Johnson's leadership ambitions, Philip Hammond called for unity and a vision beyond Brexit. In his speech, the Chancellor mentioned he is considering a new digital sales tax to ensure that taxation between high street retailers and large technology companies is fair. He also announced a £100 million initial commitment to a national retraining scheme with the CBI and Trade Unions Congress. On the subject of Brexit, Mr Hammond predicted that the government would negotiate a deal with the EU, hinting there would be a financial windfall in the form of a deal dividend. Otherwise, we can expect a week of further squabbles from a party divided over the Chequers Agreement, which, at time of writing, the Prime Minister is determined to hold on to. Before the conference started this week, the Chancellor also confirmed that this year's autumn budget will be brought forward to Monday the 29th of October, which is exactly 5 months before Britain is due to leave the EU. Aside from the main stage, in a fringe event over the weekend, Business Secretary Greg Clark offered some hope to struggling retailers, saying that business rates in England could be changed to help high street retailers. He told delegates that the role played by high streets should be recognised and adjusting business rates will be one way of doing that. He confirmed that the Treasury is conducting a review of business rates, which was welcomed by the Federation of Small Businesses. In other news, on the company front, we're due second quarter results from Tesco on Wednesday. Britain's largest supermarket chain has had a tough time lately as Chief Executive Dave Lewis continues with his turnaround strategy. So far, it seems to be working as the group finished last year with a 28% jump in profits and its first full-year dividend payout to shareholders in 3 years. However, as well as the move to shopping online, Tesco faces stiff competition from the German discounters such as Aldi and Lidl, who have already carved out a 13% share of the UK grocery market. Tesco has now decided to go head-to-head with them with the launch of Jack's. Opening its first Jack's store in Cambridgeshire with more planned over the coming months, Tesco's new discount venture will sell a limited range of 2,600 cut-price products, far fewer than the 35,000 a typical Tesco supermarket would sell, but more than the 1,800 products a typical Aldi store would offer. Meanwhile, Aldi are showing no signs of a slowdown in their UK expansion plans, as they announced on Monday that they expect to open 130 stores over the next 2 years and expand to 1,200 stores in the UK by 2025. The company said sales in the UK and Ireland rose 16% in 2017. At the same time, operating profit rose 29%. When asked about the launch of Jack's, Giles Hurley, Aldi's UK and Ireland chief executive, said imitation was the sincerest form of flattery, and we think it will be a real struggle for complex supermarkets to copy our business model. As well as launching Jack's, Tesco is also dipping its toe back into European markets with a strategic alliance with French group Carrefour in an effort to cut costs and win back market share from the discounters. In other news, the Paris Motor Show starts on Thursday, where the future of electric cars will no doubt be top of the agenda. One key player that can't seem to stay out of the headlines at the moment is Elon Musk, co-founder and CEO of Tesla, the electric vehicle manufacturer. Elon Musk is the 25th richest person in the world according to Forbes, which estimates his net worth to be just under $20 billion. Before setting up Tesla and rocket company SpaceX, he made his fortune from creating online payments firm PayPal. On Friday, Tesla shares dropped, temporarily wiping $6 billion from the company's market value. This was due to a fraud complaint filed by the Securities and Exchange Commission. It alleged that Mr Musk had made false and misleading statements in the wake of a tweet he sent in August. The tweet said he had funding secured to take the company off the stock market and into private hands at $420 per share. The Securities and Exchange Commission said the tweet could amount to fraud or market manipulation by artificially inflating the stock market price. However, over the weekend, Elon Musk reached a deal with the Commission. Under the deal, Mr. Musk will remain as Tesla's CEO, but will step down as chairman for 3 years. Both he and Tesla will also have to pay a $20 million fine. He will also have to comply with Tesla's communications procedures when tweeting about the firm. The stock market has welcomed the news, with Tesla's shares rebounding yesterday, closing up 17% at $310. Still in the US, stocks rose sharply on Monday as investors cheered news of Canada joining a trade deal with the United States and Mexico. The new agreement, to be officially called the rather aptly named US-Mexico-Canada Agreement, now includes rules for financial services and digital businesses that have emerged since NAFTA was originally signed in 1994. Canada agreed to curb protection for its dairy industry, while the US dropped demands to get rid of special NAFTA courts that allow member states to challenge trade restrictions imposed by others. Investors in the US will also be paying close attention to the non-farm payroll employment figures due this Friday. Expectations are for 185,000 new jobs in September, while the unemployment rate is expected to fall to 3.8%. Finally, over on this side of the Atlantic, an unscheduled update from the Royal Mail an hour before the London market closed last night led to Royal Mail shares falling by almost 20%. The UK Postal Service said letter volume had fallen by 7% in the first half of this financial year and warned core profits would be 20% lower this year because of missed productivity and cost-saving targets. As a result of this disappointing performance, Royal Mail has also reduced its cost avoidance target from £230 million to £100 million this year, adding that it was implementing a range of short-term cost measures. That's all for this week. Join us next week for more market news.